If you've been recently following the stock market or if you've just been reading the news, you've probably heard everyone talking about interest rates a lot. And this is because last week Jerome Powell actually gave a speech where he pretty much said that it was very likely that the Fed would start to cut rates starting on September. This, of course, was met with a lot of excitement. The stock market went up a couple of percentage points, and now every single investor is wondering what to do. Should you invest in the stock market before the interest rates are cut? Should you wait and see what happens? But how does the S&P actually perform after there's been a rate cuts? Well, the general belief is the quote that you're seeing on your screen. It's sort of like a teeter-totter. When interest rates go down, prices go up. Today we'll be seeing if that's true. With real market evidence, we'll be discussing what interest rates are, what the theory actually suggests, and bringing up a practical example to see what has actually happened throughout history. But before we start, we need to understand what is happening. This graph shows the interest rate per quarter all the way since 2022. And as you can see, interest rates were increased at the start of 2022 as a lever to try to control inflation and to help everyone who was struggling with rising prices. The rate hikes were actually stopped in Q3 2023, where they have remained since then, and the current rate is 5.25%. We have Morningstar's forecast, which is pretty aligned with the consensus belief of the whole stock market, and they suggest that the first cut in September will be a 0.25 basis points cut, meaning that the new interest rate will be 5%. However, you do need to be aware that although the majority of the market actually believes this, as the quote below says, forecasts create the mirage that the future is knowable. It's extremely difficult to actually project this accordingly. The majority of the times actually consensus is wrong, but it gives us a clear idea of more or less what the market is expecting. So now the real question is, do rate cuts actually increase the price of the S&P 500? Warren Buffett actually states that interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there is a very low gravitational pull on asset prices, meaning that when there are low interest rates, asset prices tend to rise because there is more accessibility to debt. But when we look at this chart, we can actually see that there was a decrease in the financial crisis, which is a period in time where interest rates were hiked as a response to a major recession. We can also see that the stock market pulled back sharply during COVID-19, and this also aligns with a time where the Fed was actually increasing interest rates in order to slow down the economy. However, it quickly recovered due to the Fed decreasing interest rates all the way down to zero. And now we're facing the same consequences, where due to post-COVID inflation, the market has actually faced a small pullback, which is very well aligned with the timing of the Fed increasing interest rates in order to combat inflation. And this chart over here shows the historic interest rate movements, and we can see just in which case of occasions these interest rates are moved, because the first major decline was the dot-com bubble, where in response to a major crisis and a major stock market downturn, interest rates were actually lowered in order to reactivate the economy. Then we see a steep increase and a steep decrease a couple of years afterwards, which was the financial crisis we just spoke about. Here, interest rates were increased because the economy was growing at too fast a pace and they wanted to control inflation. However, after the market collapse and the recession started, they were very quick to drop down interest rates all the way down to zero. The next hike was in COVID-19, where they also wanted to slow down the economy a bit, but then COVID happened and they were forced to go all the way down to zero with their interest rates. And now once more, due to post-COVID inflation, the interest rate has been increased to 5.25%. So what are some common reasons to decrease interest rates? Well, the first one is to stimulate economic growth. When you decrease interest rates, there is more opportunity to borrow money and it gives more confidence to the consumer. So there is higher spending, of course, because you give more access to debt, and also companies invest and spend a lot more. Number two is that it promotes job creation because corporations will invest a lot more during these time periods since they have wider access to debt. Number three again is that it reduces debt burdens for those companies that were paying high interest rates, or for those individuals which had a very high mortgage. You're able to refinance everything at a way cheaper interest rate, which allows you to have a lot more disposable income. Number four is to weaken the domestic currency, and this is normally done when a country wants to export more of their products. Number five is to achieve inflation targets. Now number six is to stabilize financial market distress, and we actually saw this with the financial crisis, while they decreased interest rates to help banks and other financial institutions survive. Now, theory suggests that there are three main reasons why rate cuts actually increase asset prices. The first one is that there is a lower cost of borrowing. Over here, we can see the global bond issuance in $1 billion from 2016 all the way up to 2023. This is a great indicator of how much debt companies are actually taking on every single year. And as we can see, from 2019 to 2021, they were taking more and more debt to survive the COVID-19 pandemic. However, in 2022, there was a clear cutback, and this is because interest rates were actually risen. Rate cuts incentivizes a lot of companies to take on more debt, which allows them to grow at a faster rate. Theory number 2 is that rate cuts actually increases the valuations for companies. If you're into finance, you've probably heard of the discounted cash flow before. This is a very common way of figuring out the fair value or the intrinsic value of a company. This is an exercise to reflect that money today is not worth the same as money tomorrow. Just think about 10 years ago and what you could buy with $5. Now think of what you can buy with $5 right now. It's a lot less, right? Well, this is the exercise that they do. They take the future cash flows and they estimate what they would be worth today. The way they do this is by estimating how much the cash flow would be worth right now by using the current interest rate. The one thing you have to remember here is that the lower the interest rate, the higher the discounted free cash flow would be, which would inherently raise the valuations for all companies in the stock market for investors which are using the discounted cash flow. And now theory number 3 is the shift from bonds. We don't normally think about it, but the global bond market is massive. In 2024, it's estimated to be worth at around $128 trillion. And when interest rate decreases, this inherently affects the bond market because a bond that was paying you a, let's call it dividend of 5.25% previously will now be paying you 5%. It may not seem like a huge drop-off, but there is a threshold where a lot of companies and a lot of massive investors will move all of this capital into the stock market in order to get some performance. This is normally thought to increase the prices of all different asset classes, except from, of course, bonds, because it's where all the money is being taken out of. But what does history tell us? Well, here we have some market research by Duncan Lamont at Schroders, who went through the hassle to actually see what the returns were 1 year after the rate cuts. When the rates were being cut due to a response in economic downturn, the stock market in the next year returned an average of 8%, while government bonds and corporate bonds returned on average a 7% and cash around 2.5%. However, when the rate cuts were in a response to controlling inflation, the stock market rose that year on average 17%, while government bonds raised only 2% and corporate bonds 4%, while cash staying more or less the same. So now our job is to decide, why are interest rates being decreased? Is it in response to controlling inflation or is it in response to an economic downturn? Because the movie changes a lot depending on which one we're in. I personally believe that it's a mix of both, because interest rates haven't been cut earlier because of inflation being too high, but they needed to be cut either way because there were risks of an economic downturn or a recession. So what will I be doing with these news? Will I be continuing with my strategy, which is to find great firms, wait until I can see them at a fair value or an attractive valuation, and then buy them and hold them for the long run. As Shelby McDavis says, you should be ready to invest for the long haul. Don't get too greedy and don't get too scared. No one can predict what the economy will do. So you should develop a strategy where you feel safe in either economic condition. So thank you so much for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content and there is a link in bio for a free stock if you join Trade Republic.